Okay, so thanks everyone for coming. Super excited to host this talk for you about the financial aspects of buying a business. We have with us from EY, John Mitchell. For a quick introduction on him, he is a member of the Atlantic Canada corporate finance team at EY. He specializes in all facets of corporate finance, including advising corporate private equity clients and acquisition, divestiture, capital raise, financing, and mandates. John also has experience working in financial assurance, serving both public and private companies across many industries. So he's agreed to do a presentation for us today for our sector, and we will, can just let him take it away, and then I'll pause for questions, and I can field those, either at the end or during the presentation if you prefer. John? And a quick reminder, I'm Andre. For those of us who don't know me, I work at the Community Sector Council, Newfoundland and Labrador, working on the SETA program that helps folks acquire businesses in the community sector. So with that, I'll pass it over to you, John, if you want to take it away.
Thanks, Andre. Yeah, hi everybody. Nice to be here. Great to be here. Nice to sort of see all your faces virtually. I'll just get started here because we have sort of like a lot of content to get through, and I just want to make sure that we can touch on all of it. And really quickly, I think I'll just give an overview of EY's M&A practice, because I think, probably most of you would be more familiar with EY's audit and tax practices. So just giving an idea of like what it is we do and how that kind of fits into this conversation. So first page here is just an overview of EY's business units and the main service lines that fall under the transactions group. So just a few sort of high level metrics. There's about 15,000 transaction professionals under EY globally, and about 5,500 in North America. In the M&A lead advisory group, which is the group I belong to, our main role is really deal execution and supporting our clients with buy-side M&A advisory, sell-side M&A advisory, and capital raise scenarios. And then I guess sort of double clicking onto that, there's about 2,500 professionals across the globe under the M&A group, and about 70 of those professionals are in Canada, sort of spread across most of the major cities, as you can kind of see on that map there. We're a mid-market investment bank or M&A advisory firm, and we advise on typically around 50 transactions a year, kind of ranging in enterprise value from sort of like 30 million to 500 million plus. So sort of a wide bucket there, but that's just to give you an idea of sort of the lens that we're looking at this through, and sort of if that kind of fits into your business or what you're looking at in terms of acquisitions or whatever it may be. That's sort of just a ballpark. And if it's not, like, I think a lot of the information that we'll be discussing today is widely applicable anyways. And there should be some good information in here for you. Okay, so moving on, just sort of a general overview first. The topics that we're going to cover today are hopefully very beneficial, but will be kept at a fairly high level given we're speaking broadly about process and not about specific industry considerations. And so like, just, I guess, keep that in mind when we're talking, but it should be lots of good information here regardless. I first want to touch on some divestiture preparation considerations for business owners as they prepare to sell their business. And so the first slide here is a question that we get a lot is when's the best time to sell? There are a number of factors that influence the perceived value of a business, including like macro, industry, and business factors. And sort of like when we touch on macro, we think about sort of like low cost of capital is like when GDP growth is high and cost of capital is low, which is sort of the scenario we had in 2020 to 2022. During COVID, when interest rates were incredibly low, we saw a really strong M&A market and a lot of activity across a variety of different sectors. So sort of a good fact set there. More specifically, industry considerations. So if your industry is in an upcycle, if there's a lot of motivated purchasers in your industry, a great example of that right now would be tech. Really hot M&A market. We do a lot of work with tech companies, and that's probably our hottest field right now, to be honest. So there's a lot of industry consolidators and a lot of people looking to purchase in the tech field right now. And that's broad tech. There's a lot of different areas of tech, but just keeping it very broad. It's a hot market, and it's driving values up because of that. So those two things are sort of outside of a business owner's control, but what a business owner can control is when they sell. And the answer to the question, when's the best time to sell, is really, it depends, but you shouldn't wait until you have to sell the business. So if there are personal or operational issues that necessitate the sale of your business in the immediate term, it creates a scenario where you have to sell your business. But it's best to be in a position where you want to sell your business and don't have to take a deal if the terms aren't attractive to you. So a few things to consider for timing in terms of like business operations. After you finish a good year is a really great time to sell. If you have sort of a pathway of tangible growth to achieving a good result next year and in coming years, that's really helpful as well. So there's just a few considerations. Timing is always a challenge with these things, and you can't time the market, but just a few things to consider. In terms of what to expect and how to prepare for a transaction, still from a sell side perspective, the sale process can be really complex and emotional, especially for someone who hasn't taken part in one before. People often underestimate the time commitment needed during the process, especially during due diligence, where the buying party will need to understand and obtain details of really all facets of the business, which it definitely will include financial, operational, and commercial, but could also include human resources, IT, intellectual property, tax, legal, real estate, and the list goes on. There are other areas as well. So the process, it's intensive, and it can take anywhere from 6 to 9 months typically. It's important to understand what will be expected and follow a structured process to maximize value for that reason, because it is a very demanding process. And so thinking about like what you can do to prepare for that, a few mitigating areas are sort of preparing early by keeping a clean record of all key business documents, preparing or cleaning up financial statements, including sort of a balance sheet, income statement, and cash flow. That's really important to buyers. Sort of keeping the 3-statement model is important. Understanding your objectives of the transaction and making sure you're addressing those in the parties you solicit to. And we'll dive a bit deeper on that in a moment. Evaluating the business like a buyer, objectively and realistically. So it's better to do this up front before anyone else sees the details, so that you're prepared to answer questions when they come. I think it's really what we see a lot is that it's very easy for business owners who may have been operating their business a certain way for years to take key pieces of information and understanding of the business for granted. So it's important to kind of take a step back and ensure that you evaluate your business in a balanced manner, sort of in a similar way to a way that a buyer would when they're looking at it. And I think, yeah, so just kind of like double clicking on objectives and priorities for a shareholder. It's important to ensure that your management, and your shareholder group are aligned on the strategic objectives of a transaction. It's common for business owners to have a preference for the highest value offer, but so thinking about the right partner may not be the same for everybody. And you should give thought in advance to whether you want to partner with a financial partner to support growth via capital investment and sort of be more hands-off in the business, or if you want a strategic investor who knows your industry and wouldn't require you to play a large role in the business going forward. No, I mean, not necessarily, but it's more common with a strategic investor that they wouldn't require you to play a larger role. Or I think maybe more commonly, a seamless transition in ownership to management, which can often, but not always, come with sort of issues around availability of capital and perhaps a lower purchase price, but not always the case. Another key point is ensuring you're choosing a competent partner who can run a timely process and has certainty of closing. This limits the risk of somebody pulling out at the last second. And I think what I mean here by this is all else being equal, if you're at a stage where you have multiple options, choosing to go down a path with a partner who has a track record of M&A can limit uncertainty in a process, given you know that they have a desire and ability to close deals. And then I think more thinking like shifting from objectives and thinking more about priorities, it's important to remember through a transaction that to continue operating the business as usual while also managing the load of the transaction process, because it's important to show sort of strong progress and results against the budget that you would give to buyers. So here really it's kind of like more digging deeper on some of the objective assessment of your business and fleshes out that point a bit further across a few key areas. So strategic positioning, overall industry analysis, and then sort of like prerequisites and getting the business ready to sell. I think a few that I would pull out here as really kind of like key items are the financial statement and budget, making sure that you have a tangible and achievable budget, and you have a clean set of financial statements, which includes balance sheet, income statement, and cash flow statement. And I think some important considerations for prerequisites. I don't love that word, but sort of like things to consider prior to a sale process. They're not necessarily prerequisites, but more sort of like important considerations. Two that I would pick out on that list are commitment to selling and executive buy-in. Given the process can be very demanding, it's important to be committed and prepared for a rigorous process. And then another key one here is current and future tax planning. Working with a tax professional to create a step plan can help maximize after-tax proceeds. And I think we'll discuss that a little bit further on in the presentation as well. But certainly something to consider prior to a transaction, because sometimes those plans can take years to come into effect. So doing a deeper dive on strategic position, I think this chart is a really good way to consider your position at a high level and evaluate some value enhancers and detractors. And so I won't go through all of them. I'll just kind of give a quick example. So like sort of customer dependency can either be a value enhancer if your customers are sort of widespread and none account for a significant portion of revenues, or it can be a detractor if you have one customer accounting for a large portion of your revenues. And the same can be said for supplier dependency and barriers to entry. If there's high barriers to entry, then that would increase value. Low barriers to entry, what's stopping a buyer from kind of coming into your industry themselves is the way that they would look at it. So it's important to be aware of the aspects that make your business attractive, but also understand some concerns that buyers may have along the process and think of positioning for those items ahead of time. Again, so really kind of, this is kind of going, I think it would be repetitive to talk about a lot of the short-term value enhancers here. But making sure that you have a good set of financial statements and a detailed forecast, optimizing the balance sheet, making sure that there are sort of like no non-business related expenses or items on the balance sheet, or limiting them to the extent that you can, I think is really important and key in a process. It just shows a little bit more professionalism. And then in terms of long-term value enhancers, which are probably more important, it would be making yourself being sort of the shareholder or business owner redundant and giving yourself the ability to step away from the business. In other words, you don't want the business to be dependent on you being a part of it going forward, unless you want to continue being a part of the business and the operations indefinitely. Also, if you don't currently, having audited financial statements prepared gives buyers a lot of comfort over the financial results, and it is sort of like it's an important stepping stone or first step, I guess, in getting comfort over the financials. And so here, this slide really just outlines kind of a broad spectrum of different liquidity options for business owner looking for a liquidity event or full divestiture. From my understanding, it sounds like management buyout is the most likely scenario for many of the folks on the call today, which can kind of facilitate a more seamless process and less upfront work, given management's knowledge of the business and ability to transition ownership easily. The trade-off here is often a reduction in total price paid for the business, but that isn't always the case. I would say kind of diving deeper a little bit more on 3 here, this next slide kind of highlights what we believe to be the most likely scenarios for business owners on this call, and is typically who we work with most closely on transactions. So I think, the overarching, I won't go into the details of each of these, but the overarching comment here is that generally speaking, again, with a private equity firm, you're trading a higher price and access to financial capital for a more onerous process and having to sort of hold their hand through the process, as they'll likely have a more limited understanding of your industry and business. That's not always the case. Sometimes they already have investments in the industry and they have a good understanding, but more generally speaking, they will have less knowledge, certainly, than your management team, and likely less knowledge than strategic competitors in the industry. Okay. So that kind of brings us to the end of the first section, which is considerations for business owners looking to sell. And now sort of going through more of a process, switching gears to talk about process considerations through the lens of a purchaser. And we can look at typical process structure and key milestones along the process here. So on this first slide, based on what I understand, it sounds like sections 1 and 2 likely aren't as relevant. So I'll focus my discussion more on performing the due diligence and executing a transaction. But if it's of any interest and you have questions, please feel free to ask them about sort of approach for selecting and prioritizing targets sort of in the Q&A period. I'm happy to field those questions if that's of any interest to anybody. So I think kind of just going through the list under the third tranche here, prior to signing a letter of intent, there's typically a period of investigative due diligence, which is typically where an owner gives broad, high-level access to key financial and operational details of the business. And that's really meant to help a prospective buyer form an opinion, a general high-level opinion on the valuation of the business. In the case of a management buyout, much of that information, if not all, is likely already available to the purchaser. So it makes that a little bit more of a seamless process. And I think a lot of the information that is important ahead of executing an LOI or even drafting an LOI, LOI is letter of intent. I think a lot of the information that's important is sort of, again, income statement, balance sheet, cash flow statement, and then sort of key business documents related to the business at hand. So, contracts in place with suppliers, customers, any operational details like a top 10 customer list, supplier list, any key high value assets to highlight, sort of things like that are fundamental to the business and maybe don't come out in the details of the financial statements as much as they could or should. And so after the buyer is comfortable with the details they've been provided, they can work with management to draft and execute a letter of intent. And typically a letter of intent would include sort of a structure of proceeds, a source of or sources of capital, and other important operational considerations. Once the LOI is signed, confirmatory due diligence starts, which is where all key business details are provided to help assess the business. And typically, external due diligence advisors are engaged in this stage. For most commonly, I think we see them for sections like financial, insurance, legal, and IT. But if they have an industry focus, they can probably help with operational or commercial due diligence as well. And then typically, so kind of going along that external due diligence line again, the advisory line, like I think they'll provide a report with their findings and any recommendations to adjustments after their diligence. And then, after all of the confirmatory due diligence is complete and both parties are satisfied with the findings, there may be diligence findings that affect valuation or shift it slightly. And those are kind of typically dealt with by discussion and negotiation between yourselves and the lawyers. Yourselves being the buyer and the seller and their respective lawyers. And so that all kind of comes out in the sale and purchase agreement of the business. And I think, for that stage, sort of after LOI, and probably after LOI and during confirmatory due diligence is when you would want to start engaging with lawyers. There's a lot of really great M&A lawyers in Halifax. I think there's some in St. John's as well. And so I think kind of engaging with them to support you through the purchase agreement drafting and execution process is really important, and something I strongly advise. Next slide here is really kind of just digging a little bit deeper on areas that a buyer typically looks at in confirmatory due diligence. So looking at commercial and operational diligence and financial due diligence. I would say like any one of these bullet points are kind of levers that can increase or decrease perceived value. And an external advisor would include any unusual findings worth noting in their report to you. And if you choose to do diligence without an external advisor, these are kind of like the key areas to look at, I would say. And I think like just to give an example of kind of how it functions and what the metric is, like picking out an example, if you're looking at CapEx requirements for a business, like if the business that you're looking to acquire requires a lot of capital investment on an annual basis, and the business stops acquiring equipment during the M&A process, which happens sort of more than you would think. This would likely result in a diligence finding, and there may be an adjustment to the net proceeds that go to the shareholders based on the deficiency in investment. So as an example, say like they typically invest 5 million, but this year they invested 1 million in CapEx. There may just be sort of a $4 million reduction to the purchase price. Is a kind of a good way to think about it in very plain, simple terms. So thinking about financial due diligence and kind of key areas on the income statement, I think this outlines the typical framework for financial due diligence, and it showed why due diligence is really important in an M&A process. The key valuation inputs here are reported EBITDA and adjusted EBITDA, which adjusted EBITDA is sort of adjustments that include discretionary adjustments that are deemed to be sort of redundant to the business and not required for ongoing business operations. We'll delve into that after this slide, but I think enterprise, like after the adjusted EBITDA, that kind of brings us down to enterprise value when you apply a multiple to that EBITDA. And that's really just another way of saying the total value of the business and what the purchase price is for the business, like the kind of the headline number on the purchase agreement, for lack of a better term. The reason it's important to perform due diligence and not just rely on an audit is because audits are performed for financial reporting purposes with generally accepted accounting principles in mind. And to get down to an adjusted EBITDA, and sorry for folks who maybe are not as familiar with the term EBITDA, it's a financial metric. It's earnings before interest, tax, depreciation, and amortization. I don't know the level of people, and I just want to be sure that that's not kind of getting missed. And so going back to what I was saying, the reason it's important, like once you get down to an adjusted EBITDA, it's then used to value the business. So you need to account for any adjustments from the accounting results And you know, there's kind of like a number of those that that you would want to look at. So you know, looking at trial balances, audit working papers, discussions with management, and kind of like a number of other things here that we'll kind of flesh that out a little bit more on the next slide as well. So I'll just move there. So some key adjustments, kind of just reading through the list here, non-recurring adjustments to EBITDA, typically large one-time costs that aren't expected in the future. So a couple examples that we typically see are tax planning costs in a given year, likely not something that you're going to incur on a regular recurring basis. So those get added back usually. Unusual legal fees, also sometimes associated with tax planning, could be a lawsuit, could be anything, but those would also get added back. Transaction related fees, so sort of like paying the M&A advisor or the external advisors that are supporting the transaction. That's not a recurring cost, so those would get added back as well. And then thinking about accounting and non-cash adjustments, typically include accounting related entries that don't impact cash inflows and outflows of the business. So things like timing of revenue recognition, bad debt provisions, impairment charges, and they're like unrealized gains, like a number of sort of non-cash related adjustments that don't actually impact the profitability of the business or sort of the money that's going into the business owner's jeans. And then thinking about, I guess, run rate and pro forma adjustments, I think a good way to think about these adjustments, they're both very similar in nature. I think giving an example, think about like if you open a new store or a new office, whatever it is, and it's like 2 months before your year end. Excuse me, there's likely a period of time before the store is running at 100% rate. But the buyer, if you're selling the business or buying the business, whichever lens you're looking at it from, the buyer would in the future be benefiting from that 100% run rate at some point. So you should estimate what the run rate would be and make a positive EBITDA adjustment to reflect that in your earnings today. So just still financial due diligence, but also thinking about sort of deal structuring. Deals are typically expressed on a cash-free, debt-free basis. And what that means is that the business owner gets to keep the excess cash in the business, but has to pay off all of the outstanding debt on the business as part of the transaction. There's also in a deal, it would include a normal level of working capital, which is for folks who may not know, is sort of a current operating assets of the business less the current operating liabilities of the business, and it's meant to represent what is required to run the business on a day-to-day basis. And so determining a normal level of working capital should be sort of a negotiation between parties. It should follow historical patterns, and I think like following historical patterns is a good place to start. And then if there's any other considerations that maybe don't come out in those numbers, there's sort of a negotiation from there. And so when we think about setting a target or a normal level of working capital, at close, if there's sort of an excess or a deficiency in working capital, there would be an adjustment on the closing proceeds as well. Okay, so moving on to sort of just an overview of funding alternatives and capital structure alternatives, I guess. There's just a few, this is just an example of a few common capital structures, I would say. I won't go through each of these, but you can kind of see the respective options, their cost of capital, associated risk, and flexibility. What I will say is the higher cost of equity kind of reflects the greater risk taken on by equity investors compared to debt holders, along with their expectation for higher returns because of the risk that they're taking on. So while equity can provide necessary capital, it often comes with less flexibility due to the ownership stakes and expectation of investors, whereas debt can still allow the company or the acquiring party to maintain control over their operations, and they don't have to sort of ask permission or talk or work with a partner to decide what the best route is for the business. I think kind of looking right down the middle, mezzanine financing is often it's a hybrid investment that offers companies a way to access capital while still maintaining control. It provides investors with a mix of fixed returns and potential equity upside. So it's a valuable option and a pretty common option for businesses looking to grow without overly diluting their ownership. But that's not a recommendation by any means. It's certainly like your capital structure would depend on your organization and your goals. So this is really just sort of meant to show you an overview of the options. Okay, kind of moving on to valuation considerations. I think we can kind of quickly first discuss how we communicate value in a business setting, which is typically focused on sustainable EBITDA. So we were talking about adjusted and reported EBITDA before, and so a sustainable EBITDA is sort of what you think the business is going to do on a recurring basis into the future. And so sustainable EBITDA kind of, it acts for a proxy of the company's operating cash flow. It helps us see how much cash the business generates from its core operations by eliminating the effects of financial and capital expenditures. And then we often make adjustments to sustainable EBITDA, like those are sort of what we just discussed, the different one-time and pro forma and run rate adjustments that we just walked through. And then thinking about how to get from EBITDA to enterprise value, which is the price of the business, you have to apply an EBITDA multiple, which is, again, like this is just high level, but they're determined by sort of a variety of factors. If you look at the funnel on the right of the page here, there's kind of a variety of different operational, financial, and market factors. These can all vary significantly depending on the specific industry and unique circumstances of the business. But it's really just meant to account for, market position, operational excellence or lack thereof, and then financial factors if it's performing sort of above market or below market, would kind of increase or decrease that EBITDA multiple. And of course, a higher multiple means a higher overall value, a higher overall enterprise value. And so I thought this example here, sort of the three last bullets, was kind of a good way of to show how a valuation can flow from EBITDA to enterprise value to equity value to value per share. So just thinking about this, like if you follow along with the logic, like let's say there's $30 million in sustainable EBITDA for a business, and the EBITDA multiple is determined at 10 times, which is kind of a high multiple. That would be $300 million of enterprise value. The equity value takes into account the debt of the business. So the debt in a transaction would be paid off by the business owner. So let's say there's $50 million in debt and the enterprise value is $300 million. That means the net proceeds to the shareholder would be $250 million. And thinking about share value on a price per share basis, let's say there's 50 million shares, that $250 million equity value gets divided by the number of shares, and the total number or the total share value per share would be $50. So just sort of an illustrative example of how that flows. And so when we think about valuing a business and sort of different methodologies of doing so, there's a few different methods. The three main ones would be comparable public company analysis, looking at precedent transactions, and then a more fundamental view, looking at a discounted cash flow or a leveraged buyout analysis. So I'll give just maybe a high level overview of comparable public company and precedent transactions quickly. Kind of looking at both public companies that are similar to your business, or the business that you're looking at, and precedent transactions, and looking at recent transactions in the industry, and kind of deriving an EBITDA multiple based on that, or a general value of the business based on that. It's more of a rule of thumb than a perfect valuation method. It's kind of like I would call it like a secondary check to make sure that you're in the right ballpark if you're doing a valuation. The problem with these methods, depending on the industry, is that a lot of the information is not publicly available, or there isn't a good enough public company comparison or good enough precedent transactions to evaluate this business on. So for that reason, I think a discounted cash flow or leveraged buyout analysis probably makes the most sense in this situation. And it's like, I think it's always the best starting point to do sort of a more fundamental analysis. And so when we think about what that looks like, it really involves looking at the financial projections of the business, and sort of like looking at what you think it's going to do in the future, discounting it back using a relevant discount rate that you may have derived from one of the public company analysis, and then determining what you think the business is worth based on that. So you can really use a variety of different methods here, but I think a good starting point typically is a DCF, a discounted cash flow. This slide is kind of just addressing a typical issue between vendors and buyers in a business transaction. So it's not uncommon for there to be a gap between vendor and buyer perspectives. Typically, the vendor believes the business is worth more than the buyer is willing to pay for it in upfront cash. And then the buyer typically takes a more pragmatic view of the forecast and needs more structure in the transaction to feel comfortable with the valuation the vendor's requesting. I think when we think about bridging this gap, these can often be bridged with additional what we call structuring of agreements. And there's a number of deal levers that you can pull on to structure a deal so that sort of the vendor is rewarded for any upside of the business, while also you're protecting yourself from any potential downside of the business operations in the future. So I think we kind of like touch on some of those here. Some examples of the deal levers that can be leveraged to bridge the valuation gap are cash earnouts based on business performance. So to give an example, if and maybe just going back to that previous slide quickly, like if, let's say, like the vendor is up here at like $5 million of EBITDA and you're down here at $3 million of EBITDA, you can offer a earnout on the milestone of earning $5 million of EBITDA, so that they're protected from, or sorry, you're depending on what perspective you're looking at, the buyer is protected from the downside, i.e. not earning what the business owner said they would, but also you get to participate in the upside in the event that they do kind of earn what they thought they would. So I think this is probably the best metric, or the most commonly used metric to bridge the gap between value. But there are other levers listed here, like contingent consideration, which is sort of similar to earnouts, and vendor financing, which could also be relevant in some of the situations here. So I think now that we've gone through valuation considerations of a business, I wanted to walk through an example of how transaction proceeds flow from enterprise value to pre-tax considerations to shareholders. So, looking at the example on the page here, If we start with an assumed $25 million of enterprise value, and we've talked about working capital adjustments already, but depending on the difference between the actual working capital and the target working capital at close, there may be a positive or negative adjustment to working capital. Here, just for illustrative purposes, we left it as blank, but it's very uncommon to have working capital equal the target working capital. So from there, you would sort of, the business owner would get the cash back from the business and have to pay off the debt, which brings you down to equity value or sort of pre-tax proceeds. And so that's sort of from there, your tax planning comes into play, and your after-tax proceeds are sort of dependent on whatever your business's circumstances are, and whatever tax planning you had in place with your tax planning advisor, which is a good kind of segue into my next slide, which talks about tax implications of a transaction. So now that we've shown what tax proceeds can look like, or pre-tax proceeds, sorry, can look like, I wanted to take a high level look at sort of some opportunities related to tax implications of a transaction. I think before we dive in here, I think it's important to note that while these are very high level levers and tools to consider, I'm not a tax professional, and each business has a very different set of case facts, and therefore different tax tools at its disposal. There are experts who specialize solely in transaction tax planning, and they can provide invaluable guidance to help maximize after-tax proceeds. So we have some at EY. There's, any of the big accounting firms have them. And so I think engaging with these professionals can ensure that you navigate the complexities of tax implications effectively. But I think, that being said, we can discuss some kind of like high level considerations and key points here. For sort of like picking a few out of the list on the opportunities side, like deal structure, the choice between asset, share, or a hybrid structure deal can significantly impact tax outcomes. So it's essential to consider the most beneficial option there. Like I said, I've said a few times, it varies on the industry, it varies on the business. Earnouts and deferred consideration, there are arrangements that can help manage tax liabilities by sort of smoothing out the tax liability recognition over time. Capital gains strategies, so utilizing capital gains exemptions and reserves can provide tax relief and allow sellers to retain more of their proceeds. And then sort of utilization of losses. So if there's any previous capital losses or any, it would have to be capital losses, I think, that can offset gains from the transaction, that would reduce an overall tax liability. And then I think, thinking about a deemed year end as well, like being aware of any potential changes in tax treatment due to a change in control. It can also affect tax planning. So it's just something to consider with a tax planning professional. And I think with everything here, it's important to keep in mind that certain tax planning options may take years to fully mature prior to a transaction. So for a seller, sort of taking an initial step to start planning that is, I think, really helpful and important, and also important for a buyer, but maybe less so. Not quite as crucial because the tax implication isn't quite the same. And that's really all I had for you guys today. Yeah, so happy to take some questions now if you have any.
All right. Thanks so much, John. That was great. It was kind of pulling the curtain back on, the nuances of financial transactions that I don't think is always very available. So yeah, folks, if you have questions, feel free to drop them in the chat. It's a good time to pick the brain of an expert. There's one that came in, and John, maybe I'll get you to pull down your slides just so we can see you.
Oh, sure.
Okay, there we go. So what would be the tax implications affected by the structure of the buyer being a charity or a nonprofit?
It's a good question, but oh my, I stopped sharing my screen here or recording my video. It's a good question, but one that I like I said, I'm not a tax professional. Like I can't answer that question. We have a lot of really great tax professionals at EY, and you know, that's not a plug for EY. There's lots of great ones at PwC, GT, like kind of all around that would be able to give you more detailed and sort of granular information on your specific not-for-profit. But I don't feel comfortable sort of giving that information right now.
Hi,
Got
John.
it.
I can speak to it a bit if you'd like there.
Sure.
Perfect. And sorry, Andre, I joined a little bit later, but for those of you that don't know me, I work with John at EY. My name's Andrew St. George. I'm based in the St. John's office there. So there are a number of considerations to take into account there with the charity or not-for-profit. The charity tends to be more rigid in the structure. One thing that comes to mind is mainly around the CRA. So they are very focused on essentially the mandate of the entity. So essentially, if you are acquiring a not or a for-profit entity for any purpose, you want to make sure that that's in line with your goals. In addition to that, you will also want to ensure that it will keep you at the point of more of a break-even status. If it is an entity that you're acquiring for more higher levels of profits, then it really questions whether or not the goal of the not-for-profit is still in line with, sort of breaking even, sort of providing a service to the public. So those are just a couple factors to keep in mind. It varies significantly depending on the type of business and also what sort of services it's offering. So it is important to go into the details with a specific tax individual.
Awesome. Thank you. That's good to know. Um, I had a couple questions, and maybe I'll just rattle them off here. John, in some of the examples, the valuations were, large, certainly, which makes sense.
Mhm.
Do you think some of the same principles, are relevant or similar for businesses of smaller valuations, like under $1 million?
Yeah, absolutely. I think the examples that I gave are really more for illustrative purposes. The numbers, it could be $10 or it could be $500 million. It doesn't change the implications of what I said throughout the presentation. So yeah, I think a lot of what was said today is sort of widely applicable. Yeah.
Yeah, great. And then one thing you touched on in the first section was kind of when it comes to succession. One thing that I've personally seen is business owners are keen in a lot of cases to stay on and help the
Mhm.
new owner, kind of go, kind of keep the business running. Is there a typical structure that you've seen works for that? Should folks be doing advisor agreements or things like that?
Yeah, I think, it really depends on what the business owner wants. If they want to stay on as an employee, as the CEO, and there's sort of willingness on the buyer's side to have that done as well, then I think that could be a really good structure. Oftentimes, yeah, like you said, there's sort of more of a consulting role that can come into play there. I think a lot of the time, they might stay on, they might have an agreement to continue in their current capacity just under a salary for maybe, 2 to 5 years. It's negotiated and it's based on what the shareholder wants. So that's something that you would kind of discuss as you go through the process. But yeah, like I think like you said, typical structures would be sort of either agreeing to stay on for a period of multiple years, sort of on a contract basis, or working as like a separate contractor for the company.
Got it. Okay, thank you. And then one thing I think might be illustrated for some of us on the call here is, thinking about the diligence process. Are there, I imagine it's pretty broad, but are there typical blockers that you've seen come up, like common ones that folks should maybe, when they're going through the process, think about sooner rather than later, or ask questions earlier about?
From a buy side or a sell side?
Buy side.
Um, yeah, I think the financials are a really important thing to get a handle on. And I think I wouldn't say they're overemphasized, but they're certainly the focal point. I think a lot of times there might be sort of details of the business that get missed that can be key. So making sure that you're having regular conversations with management to understand the fundamentals of the business, and not just kind of digging into the numbers and assuming you understand it. Again, like it's very broad, but I think, yeah, like that's kind of what I would say to that.
All right, thanks. That's it from me. And we don't have any other questions. I guess other than that, how, if folks are interested, how can they get in contact with either you or someone at EY if they have more questions after this?
Yep. Well, you have my email, Andre. Like, if you want to share my email with anyone who's interested, like, feel free. Happy to chat with anybody at any time.
Awesome. And then we are recording this, so we'll probably put something like this on our like our YouTube channel, if that's all right. Would it be possible to get a copy of the slides for folks as well?
Yeah, sure. Yeah, I'd be happy to share those.
Okay, amazing. Well, John and Andrew, thank you so much for sharing your time and insights with us. We really appreciate it.
Yeah, happy to be here. Nice to meet you all.
Anytime.
All right. See you, everybody.
Thanks, everyone.
Take care.